Most people think investing is complicated, but the truth is, a single index changed everything. Stay with me until the end because most people never learn this about money, and understanding it could completely change how you think about investing. And before we dive in, I'm curious, do you already invest in the stock market, or are you just starting to learn? Let me know in the comments. It actually helps more people discover videos like this. For most of history, investing in the stock market was not designed for ordinary people. Before the 1970s, the financial world was dominated by professional fund managers, stock pickers, and large institutions. If someone wanted to invest, they usually had to rely on expensive mutual funds or financial advisors trying to beat the market. And beating the market became an obsession. Fund managers would constantly buy and sell stocks trying to outperform everyone else. The idea sounded exciting, but there was a problem. Most of them failed. Over time, researchers started noticing something strange. Many actively managed funds, even the ones run by highly paid experts, were underperforming the overall market after fees. In other words, people paying the most money for professional investing were often getting worse results. This discovery quietly challenged the entire financial industry. Then in 1976, something revolutionary happened. A man named John Bogle introduced a simple idea that many people thought was crazy. Instead of trying to beat the market, why not just own the market? That idea led to the creation of the first index fund for everyday investors. And at the center of that idea was something called the S&P 500. The S&P 500 is simply a list of 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, and many others that represent major parts of the economy. Instead of picking individual winners, an index fund allows you to invest in all of them at once. Think about it like this. Imagine trying to guess which one company will dominate the future. That's incredibly difficult. But owning a small piece of hundreds of strong companies spreads the risk and lets the overall economy work for you. At first, many people laughed at the idea. Wall Street called index funds un-American because they didn't try to beat the market. Some professionals even predicted the idea would fail. But something unexpected happened. Over the next few decades, more and more data started proving that index investing worked surprisingly well. Because index funds had lower fees, less trading, and broader diversification, many of them quietly outperformed a large number of actively managed funds over long periods. And slowly, something powerful began to happen. Millions of ordinary people started becoming investors. Teachers, engineers, small business owners, parents saving for retirement. Instead of needing deep financial knowledge or spending hours analyzing stocks, they could simply invest in a broad market index and hold it for the long term. And the S&P 500 became one of the most popular ways to do that. Stay with me for a moment because the next part explains why this idea changed financial history. The S&P 500 didn't just create a new investment strategy. It created a new mindset about money. Instead of chasing hot stocks, many investors began focusing on long-term ownership. Instead of trying to predict tomorrow's market, they started thinking about decades. And that shift turned investing into something much more accessible. Here are a few powerful lessons that came from this idea. First, diversification matters. When you invest in hundreds of companies instead of just one or two, you reduce the risk of a single mistake destroying your portfolio. Second, costs matter more than most people realize. High fees can slowly eat away at investment returns over time. Lower-cost index funds helped many investors keep more of their money working for them. Third, time in the market often matters more than timing the market. Trying to perfectly predict market highs and lows is extremely difficult. But consistently investing over long periods allows compounding to do its work. Fourth, simplicity often wins. Many complex investment strategies look impressive, but simple long-term approaches have proven surprisingly powerful. And finally, patience is one of the most valuable skills an investor can develop. Markets rise and fall. There are booms, crashes, and uncertainty. But history shows that long-term investors who stay disciplined often benefit from economic growth over time. But here's the twist most people don't think about. The S&P 500 didn't just create investors. It democratized investing. Before index funds, building wealth through the stock market often required large amounts of capital, expensive advisors, or specialized knowledge. Today, someone with a small monthly investment can own pieces of some of the largest companies in the world. In a way, the S&P 500 turned the stock market from an exclusive club into something millions of people can participate in. And that may be one of the most important financial shifts of the last century. So the next time you hear about the S&P 500 on the news, remember this. It's not just a number on a screen. It's a system that helped millions of ordinary people become investors. If you enjoyed this video and want to learn more about investing, money psychology, and building long-term assets, make sure you subscribe to the channel. And if you want to understand how small investments can grow over time, check out the next video on this channel. Stay in touch for more information.